Something very important is happening in the world and most people are looking at it in the wrong way. They see a headline about China reducing its exposure to the US dollar. They see a headline about oil prices rising. They see another headline about BRICS, gold, emerging markets, debt, inflation, or the dollar having one of its worst periods in decades. Then they move on. That is the mistake. The real story is not one headline. The real story is that the global money system is slowly changing. The system that shaped how people invested for the last 50 years is not disappearing overnight, but it is being diluted, challenged, and rebalanced. That distinction matters. A collapse is one kind of event. A dilution is another. A collapse happens fast. People notice it. It creates panic. It dominates the news. A dilution happens slowly. People underestimate it. It changes incentives, capital flows, currency values, and investment returns before most people understand what has happened. That is what I believe is important about this moment. The United States is not suddenly becoming irrelevant. The dollar is not suddenly becoming worthless. The American capital markets are not suddenly being replaced by something simple and obvious. But the world is getting bigger. The United States is no longer the only center of gravity in the global economy. Other powers are building their own systems. Other countries are looking for ways to reduce dependence on the dollar. Central banks are buying gold. Emerging markets are growing. China, India, Brazil, the Gulf states, and other economies are playing larger roles in trade, energy, manufacturing, commodities, and population growth. This is how changing world orders usually begin. They do not begin with one day when everybody wakes up and the old system is gone. They begin when the old system still looks dominant, but the incentives underneath it are changing. That is the stage most investors miss. They wait for confirmation. By the time the change is obvious, the best positioning has often already happened. So I want to explain this as a system. After World War II, the United States became the center of the global financial order. The US economy was enormous. Its capital markets were deep. Its military was powerful. Its institutions were trusted. And the dollar became the world's reserve currency. That reserve currency status gave the United States an extraordinary advantage. Other countries needed dollars to buy oil, settle trade, hold reserves, and transact internationally. Central banks held dollars because dollars were liquid, trusted, and accepted almost everywhere. Global investors bought us assets because US markets were large, transparent, and easy to access. This created what economists often call an exorbitant privilege. The United States could borrow cheaply. It could run larger deficits. It could issue debt that the rest of the world wanted to own. It could print more money than other countries could without suffering the same immediate consequences. It could finance growth, consumption, military power, technology leadership, and a very high standard of living, partly because the world needed its currency. That system was powerful, and for a long time, it made sense for investors to be heavily concentrated in the United States. The US had the best companies, the deepest capital markets, the strongest innovation engine, and the reserve currency behind it. If an American investor put most of his money into the S&P 500 over the last several decades, that was not foolish. It worked extremely well. The United States became the home of many of the world's most valuable companies: technology, software, semiconductors, internet platforms, biotech, cloud, artificial intelligence, and consumer brands created enormous wealth. But the mistake people make is assuming that because a system worked for decades, it must work the same way forever. That is not how history works. Every system has cycles. Every reserve currency has pressures. Every empire, every dominant economy. Every financial order has periods of expansion, periods of overconfidence, periods of debt accumulation, and periods when other powers rise. The key is not to panic. The key is to recognize when the balance is changing. The dollar still dominates the system today. It is used in a massive share of foreign exchange transactions. It remains central to global payments. US Treasury markets remain the deepest and most liquid in the world. When a crisis hits, money still tends to move toward the United States because investors trust the liquidity, the legal structure, and the military and financial power behind the system. That is why I do not think about this as a dollar collapse. I think about it as dollar dilution. The dollar remains dominant, but it is less dominant than it was. The United States remains central, but it is less singular than it was. The US market remains powerful, but it may not produce the same relative outperformance that investors became used to during the last long cycle. That is the important investment point. You do not need the dollar to be replaced for the dollar to weaken. You do not need the US to fail for international assets to become more attractive. You do not need China to fully replace the United States for global diversification to matter more. You only need the world to move from one dominant pole to several important poles. That is enough to change returns. Look at the reserve data described in the mother argument. The dollar share of global foreign exchange reserves was much higher roughly a decade ago. It has come down. The decline is not catastrophic, but it is meaningful. And the speed of the decline matters because it reflects behavior. Central banks do not change reserve behavior casually. They move slowly. They think in terms of security, liquidity, trade relationships, sanctions, risk, and long-term power. After the US froze Russia's foreign reserves following the invasion of Ukraine, many countries that were not firmly aligned with the United States saw something very clearly. They saw that dollar assets were not only financial assets, they were also political assets. If you are aligned with the US, the dollar system gives you safety, liquidity, and access. If you are not aligned, the dollar system can become a point of vulnerability. That realization changed incentives. It did not instantly create an alternative reserve currency, but it gave countries a reason to search for alternatives, build alternatives, and reduce their dependence wherever possible. That is the de-dollarization playbook. It does not require replacing the dollar completely, it only requires using the dollar less. China has been reducing its relative exposure to U.S. treasuries. Other countries are increasing bilateral trade settlements, meaning they transact directly in their own currencies instead of using dollars as the middle layer. Central banks are buying gold because gold is neutral, cannot be printed by a government, and is not another country's liability. New payment systems are being developed. China has its cross-border interbank payment system. BRICS countries have discussed direct payment systems. There are experiments with blockchain-based settlement frameworks among central banks. There are ideas for settlement currencies backed partly by gold and partly by baskets of currencies. Many of these systems are not yet ready to replace the dollar. Some may never become dominant, some may be too small, too complicated, too political, or too limited. But the point is not whether any one system replaces the dollar tomorrow. The point is that the incentive to build around the dollar has increased. That incentive is what matters. When enough countries want optionality, the system begins to change. Not in a straight line, not without failure, not without setbacks, but directionally, the world begins to seek more balance. That is why I think investors need to stop asking the wrong question. The wrong question is, will the dollar collapse? That question pushes people into extreme thinking. If they think yes, they panic. If they think no, they ignore the change. The better question is, what happens to my portfolio if the dollar becomes less dominant over the next 10 or 20 years? That is a more useful question, and it leads to better decisions. If the dollar weakens gradually, foreign assets can become more valuable to us investors when translated back into dollars. If emerging markets grow faster from a lower base, their stock markets may provide better returns than expensive U.S. stocks. If central banks keep buying gold, precious metals may deserve a small role as a hedge. If the world moves into a more multipolar trade system, commodities may become more important because the real economy still runs on energy, metals, food, and materials. At the same time, abandoning the United States completely would be a mistake. That is not a balanced view. The U.S. still has the deepest capital markets. It still leads in artificial intelligence, semiconductors, biotech, cloud infrastructure, venture capital, and many of the world's highest return companies. It still has an enormous military and financial infrastructure. It still has institutional advantages that are difficult to replicate. So this is not about moving from one extreme to another. It is not about being all in on America yesterday and all out tomorrow. It is about recognizing that a concentrated bet on one country, one currency, and one historical regime may be riskier now than many investors assume. That is especially true because the average American investor is heavily concentrated in U.S. markets. This made sense in the previous world, but in the next world, the risk and reward may look different. When major institutions forecast lower returns for U.S. stocks and higher returns for international or emerging markets, those forecasts are not guaranteed. Forecasts are not facts. Institutions can be wrong, but when many serious institutions independently point in the same direction, I pay attention. Not because they know the future, no one knows the future. I pay attention because their reasoning reflects valuations, starting points, growth potential, currency effects, and long-term capital market assumptions. If U.S. valuations are stretched, future returns tend to be lower. If international markets are cheaper, their expected returns can be higher. If emerging markets have more room to grow, they may provide stronger long-term opportunities. If the dollar weakens, foreign returns can be amplified for us investors. These are not emotional arguments, they are system arguments. And systems matter. The top companies in the S&P 500 now represent a very large share of the index. That concentration has made many investors feel richer because those companies have performed incredibly well. But concentration also increases risk. When a broad index depends heavily on a small number of megacap companies, it is less diversified than it appears. Many people think they own 500 companies. In reality, a large portion of their exposure is tied to the same few giants. That may still work. Those companies may still be excellent. But investors should understand what they own. An index is not always as diversified as the number in its name suggests. This matters even more when the U.S. dollar is weakening and U.S. valuations are high. The previous decade rewarded American concentration. The next decade may reward global balance. Again, this does not mean abandoning the United States. It means not assuming that the next 20 years will simply repeat the last 20. History rarely repeats that neatly. Now let us talk about China. China is central to this story, but it is not the entire story. China has been reducing the share of its reserves held in U.S. treasuries. It has built alternative payment infrastructure. It has pushed for yuan settlement in some trade relationships. It has supported frameworks that reduce dependence on the dollar and the Western-controlled SWIFT system. But China also has problems. Strict capital controls make it hard for the yuan to become a true global reserve currency. Investors want to know they can move money freely in and out. They want legal transparency. They want deep liquid capital markets. They want trust. They want confidence that politics will not overwhelm property rights. China has not yet solved those issues. That is why the yuan cannot simply replace the dollar. The same is true of other alternatives. Europe has political fragmentation and debt issues. Gold is useful as a store of value, but it is not a real-time global payment system. Bitcoin may interest some investors. but it remains too volatile to serve as a reliable short-term reserve for most central banks and institutions. BRICS systems are developing, but they do not yet have the scale, trust, and liquidity of the dollar system. This is why the transition will likely take decades, not years. But decades are exactly the time horizon that long-term investors should care about. If you wait until the alternative system is complete, the investment opportunity will not be early anymore. The opportunity is to position for a more multipolar world before it is fully accepted by everyone. That does not require extreme action. It requires thoughtful diversification. The first practical principle is simple. Do not put all of your money in one country, even if that country is the United States, even if that country has the best companies, even if that strategy worked very well in the past. A rational investor asks, am I being paid enough for this concentration risk? If the answer is unclear, diversification is sensible. A simple international index fund can help. It does not need to be complicated. Many people overcomplicate global investing because they think they need to pick the perfect country, the perfect fund, the perfect timing. That is usually not necessary. The purpose of international diversification is not to prove that one country will beat another every year. It is to avoid having your entire future tied to one market, one currency, and one return regime. That is a much more modest and more powerful idea. The second principle is to consider emerging markets carefully. Emerging markets are volatile. They carry political risk, currency risk, governance risk, and market structure risk. They can disappoint for long periods. They are not magic, but they also represent where much of the world's population growth, consumption growth, urbanization, and productivity catch-up can occur. India is a major part of this. Its population is enormous. It is younger than China. It is increasingly technology literate. It has the potential to become one of the largest economies in the world over time. That does not mean every Indian stock will be good. It does not mean buy anything with the word India attached to it. It means the global growth map is changing. If India grows into a much larger economic force, and if emerging markets expand their share of global stock market capitalization over the coming decades, investors who have no exposure may miss an important part of the world's growth. That is the point. Not all emerging markets are equal, not all prices are attractive, not all governance is strong, but from a broad portfolio perspective, the direction matters. The world is getting bigger outside the United States. Your portfolio should recognize that. The third principle is to own a little bit of real assets or hard assets as a hedge. Gold is the classic example. I do not believe gold is a productive asset in the way a great business is productive. Gold does not generate cash flow. It does not innovate. It does not grow earnings. But gold has a different role. It is a neutral asset. It is not another government's liability. It cannot be printed by a central bank. When countries worry about sanctions, currency debasement, excessive debt, or financial fragmentation, gold becomes attractive as a reserve asset. That is why central bank buying matters. When central banks buy gold at a rapid pace, it is not because they suddenly forgot how finance works. It is because gold helps them diversify away from political and currency risk. For an individual investor, gold may not need to be large, but a small allocation can make sense as a hedge in a changing world order, especially when debt levels are high and currency trust is being questioned. The fourth principle is commodities. The world still runs on physical inputs. Oil, copper, metals, food, energy, and materials are not abstractions. They are the base layer of the real economy. If emerging markets grow, they need commodities. If infrastructure expands, it needs commodities. If electrification accelerates, it needs copper, lithium, rare earths, and other inputs. If supply shocks occur, commodity prices can rise. Commodities can also be cyclical and difficult to own directly. They can be volatile, they can move in long booms and busts, so they should be approached with care. But as insurance in a world of inflation pressure, supply shocks, and changing global power, commodities deserve attention. The fifth principle is to keep meaningful U.S. exposure. This is critical. Some people hear about de-dollarization and immediately jump to an extreme conclusion. They think they should sell every U.S. asset and move everything abroad. That is not a good system. The United States still has extraordinary advantages. It has many of the best companies in the world. It leads in many of the industries that matter most for the future. Its capital markets remain deep, liquid, and trusted. Its legal and financial infrastructure is still unmatched in many respects. Even if U.S. returns are lower over the next decade, they may still be positive and important. The U.S. can still create enormous value. Artificial intelligence, semiconductors, biotech, software, financial markets, defense technology, and entrepreneurial dynamism remain powerful forces. So the right answer is not abandonment. The right answer is balance. Balance does not mean weakness. Balance means not depending on one outcome. If the United States continues to dominate, you still benefit. If the world becomes more multipolar and international markets outperform, you have exposure. If the dollar weakens, foreign assets and hard assets can help. If inflation rises, commodities and real assets may provide insulation. If global shocks increase, diversification can reduce dependence on one system. That is what good portfolio construction is. It is not prediction, it is preparation. The people who usually do best in major transitions are not the ones who predict the exact path. They are the ones who understand the direction of the forces and build a portfolio that can survive several possible outcomes. That is the real lesson. Nobody knows exactly how fast de-dollarization will move. Nobody knows whether China overtakes the United States by a specific year. Nobody knows whether India reaches a specific economic size by a specific date. Nobody knows whether the dollar reserve share drops steadily, stabilizes, or rebounds for a period. Nobody knows whether U.S. stocks underperform for 10 years or surprise everyone again. But we can know enough to avoid being fragile. If your entire portfolio depends on the dollar remaining as dominant as it has been, U.S. megacap valuations staying elevated, and American markets outperforming the world indefinitely, that is a narrow bet. It may still work, but it is narrow. A more robust portfolio says, I do not need to know the exact future. I will own US assets because they remain powerful. I will own international assets because the world is becoming more balanced. I will own emerging markets because growth is shifting. I will own some hard assets because currencies and debt cycles create risk. I will own commodities or commodity-linked exposure because the physical economy still matters. And I will stay flexible because the system is changing. That is a better frame. Now I want to explain why small changes can matter. When people hear about diversification, they sometimes think it requires a radical transformation. They think they have to sell everything, change everything, and become a different kind of investor. That is not true. In long-term investing, small allocation changes made early can have large effects over time. Moving from almost entirely U.S. exposure to a more globally diversified allocation may not feel dramatic today. But over 10 or 20 years, if international markets outperform, if the dollar weakens, and if emerging markets gain share, that small change can matter greatly. The opposite is also true. If the United States keeps outperforming, a balanced portfolio still participates because it still owns the U.S. That is the beauty of diversification. You are not making an all-or-nothing bet. You are reducing dependence on a single version of the future. The world is moving from a unipolar structure toward a more multipolar structure. In a unipolar structure, one power dominates trade, finance, military influence, reserve assets, and global capital flows. In a multipolar structure, power is spread across several major economies, blocks, and systems. That does not mean the leading power disappears. It means the leading power has to share more of the system for investors. That changes where returns can come from. It may increase the value of foreign earnings. It may increase the importance of currency diversification. It may increase demand for neutral reserve assets. It may increase commodity volatility. It may reduce the return premium investors became used to. In the U.S., it may make global index exposure more important. It may reward patience and flexibility. This is not about fear. It is about seeing the machine. I often think about economies as machines made up of transactions, incentives, debts, currencies, productivity, and power. When one part of the machine changes, other parts adjust. If countries reduce dollar reserves, demand for treasuries changes. If demand for treasuries changes, borrowing costs can change. If borrowing costs change, debt dynamics change. If debt dynamics change, currency value can change. If currency value changes, inflation and import prices can change. If inflation changes, central bank policy changes. If central bank policy changes, asset prices change. If asset prices change, portfolio returns change. That is the chain. Most people focus on one link. Serious investors study the chain. That is why the dollar matters to your portfolio even if you never trade currencies. The currency you live in shapes your purchasing power. It shapes the value of your foreign investments. It shapes inflation. It shapes interest rates. It shapes the relative attractiveness of US assets versus international assets. You cannot ignore it. But you also should not overreact. The dollar has problems, but every alternative has problems too. This is one of the reasons the dollar remains so dominant. Reserve currencies are not chosen because they are perfect. They are chosen because they are better than the alternatives on the dimensions that matter most: liquidity, trust, scale, convertibility, rule of law, military backing, and financial infrastructure. The United States still has those advantages. China does not yet provide full capital freedom. Europe is fragmented. Gold is not a payment rail. Bitcoin is volatile. BRICS payment systems are not yet large enough or trusted enough to replace the existing system. So the likely path is not a sudden replacement. It is gradual diversification away from overdependence on the dollar. That is why dilution is the right word. Dilution means the dollar remains important, but other assets, currencies, and markets gain relative importance. In a dilution environment, extreme bets are unnecessary. Balanced positioning is rational. Now let us think about the personal investor. If you are an American investor with most of your money in U.S. stocks, you are not wrong for having benefited from that. The past rewarded it. The question is whether the future will reward the same concentration to the same degree. A thoughtful investor reviews assumptions. Do I assume U.S. stocks will always outperform? Do I assume the dollar will always strengthen in crises? Do I assume the top companies can remain such a large share of the market without risk? Do I assume international markets will remain permanently unattractive? Do I assume emerging markets will never fulfill their potential? Do I assume inflation and debt do not matter? If these assumptions are hidden inside your portfolio, you should make them explicit. Every portfolio is a set of beliefs. Even an index portfolio expresses beliefs. If you own only the S&P 500, you believe us large cap companies are sufficient for your long-term future. That may be true, but it should be a conscious belief, not an inherited habit. Many investors do not choose a U.S. heavy portfolio because they analyze the world. They choose it because it is familiar, easy, and recently successful. Familiarity can become risk. A country can be excellent and still be overowned. A market can be strong and still be expensive. A currency can be dominant and still weaken. A strategy can be rational in one period and incomplete in another. That is why you must update your thinking as the environment changes. The mother argument points to several major institutions expecting international and emerging markets to produce better returns than U.S. markets over the coming decade or longer. Again, that is not a certainty, but it is consistent with valuation logic. Starting price matters. When you pay a high price for future earnings, your forward return tends to be lower. When you pay a lower price for assets with room to grow, your forward return can be higher. The U.S. has many outstanding companies, but many of them are priced with high expectations. Emerging markets may have more room to grow, but they also have more risk. The answer is not to choose one with total certainty. The answer is to size them intelligently. That is where portfolio construction becomes more art than ideology. You do not have to decide that America is finished. You do not have to decide that China will dominate. You do not have to decide that India will fulfill every projection. You do not have to decide that gold will soar. You simply have to decide that a world with more uncertainty deserves more diversification. That is reasonable, that is principled. That is how to avoid being trapped by a single narrative. One of the biggest mistakes people make in changing environments is taking the last regime and extrapolating it forever. In markets, that can be very dangerous. After U.S. stocks outperform for a long time, people believe US stocks will always outperform. After the dollar dominates for a long time, people believe the dollar's dominance cannot erode. After mega-cap technology leads for a long time, people believe nothing else can lead. This is how cycles create overconfidence. The longer a pattern works, the more people treat it as permanent. Then the environment changes and they are surprised. I do not want to be surprised by something that is already visible in the data. Dollar reserve share is lower than it was. Central banks are buying gold. Countries are building alternative settlement systems. Emerging markets are becoming larger parts of global growth. The U.S. stock market is highly concentrated. Major institutions expect lower U.S. returns and stronger international or emerging market returns. Debt is high. Deficits remain large. These are signals. They do not tell us the future precisely, but they tell us enough to adjust. What does adjustment look like? It may look like adding broad international developed market exposure. It may look like adding emerging market exposure. It may look like holding a small allocation to gold or precious metals. It may look like owning commodities or commodity-linked assets in a measured way. It may look like keeping us exposure but reducing the assumption that U.S. assets must dominate everything. It may look like rebalancing periodically rather than chasing whatever just performed best. It may look like thinking in decades rather than reacting to 1 year. Most importantly, it means building a portfolio that does not depend on perfect knowledge, because perfect knowledge does not exist. The future world order will probably be messy. The U.S. will remain powerful. China will remain important but constrained. India may grow dramatically but unevenly. Emerging markets will create opportunities and disappointments. Gold may hedge some risks but not compound like a business. Commodities may protect against inflation but remain volatile. The dollar may weaken over time but still rally during crises. U.S. stocks may underperform for a period but still include some of the best companies in the world. All of that can be true at the same time. That is why simplistic narratives are dangerous. The world is complex. Your portfolio should be simple enough to manage but broad enough to survive complexity. Now, I want to be direct about what not to do. Do not panic sell all your U.S. assets because you heard that China is dumping dollars. Do not put all your money into gold because central banks are buying it. Do not chase emerging markets after a strong year without understanding volatility. Do not assume BRICS payment systems are ready to replace the dollar tomorrow. Do not assume the dollar can never weaken because it has dominated for so long. Do not confuse short-term crisis flows with long-term structural change. Do not build a portfolio around one political opinion. Build it around risks, probabilities, and diversification. That is the principle. In changing world orders, the winners are usually not the loudest people. They are the people who stay flexible. Flexibility is an asset. When you are too concentrated, you become dependent on being right. When you are diversified, you can be approximately right across several outcomes. Approximate rightness over decades is better than precise wrongness in one concentrated bet. That is one of the most important lessons in investing. You do not need to perfectly predict the next world order. You need to avoid being destroyed by the old world order changing. That is the task. Now think about the role of the dollar in your personal life. If you live in dollars, earn in dollars, spend in dollars, save in dollars, own U.S. stocks, own U.S. bonds, and have little foreign exposure, you may be more tied to the dollar than you realize. Your income, savings, investments, and purchasing power may all depend heavily on the same currency and the same country. That is not automatically wrong, but it is a concentration. And concentration should be examined. If the dollar weakens, foreign travel becomes more expensive, imported goods become more expensive, international assets may rise in dollar terms, commodities may become more expensive, inflation pressure can increase. A globally diversified portfolio can help offset some of that. Not perfectly, but meaningfully. That is why currency diversification is not just an institutional concern. It affects ordinary investors. The same is true of global equity exposure. If emerging markets and international developed markets perform better than U.S. stocks over the next decade, Investors who have no exposure will miss that. If they underperform, a diversified investor still has us exposure. This is why I like balance. Balance keeps you from needing to make one heroic prediction. The world has a way of punishing heroic predictions. Now let us talk about time horizon. Short-term, the dollar can remain strong. Short-term, US stocks can keep outperforming. Short-term, emerging markets can disappoint. Short-term, gold can fall. Short-term, commodities can be volatile. Any of that can happen. But long-term investing is not based on short-term certainty. It is based on long-term pressures. The long-term pressures are clear enough. The US debt burden is large. Deficits remain significant. The dollar share of reserves has declined. Other countries want more optionality. China and India are becoming more important economically. Emerging markets may make up a larger share of global equity markets over time. US valuations are relatively high. These pressures suggest that diversification outside the US may be more important in the future than it was in the recent past. That is the actionable conclusion. Not panic, not prediction, diversification. I also want to address why this can be an opportunity rather than just a risk. When the world order changes, capital gets reallocated, some assets become less attractive, others become more attractive, some countries lose relative advantage, others gain, some currencies weaken, some commodities rise, some companies benefit from new trade patterns, new consumers, new infrastructure spending, and new investment flows. If you are positioned only for the old world, you may experience the change as loss. If you are positioned for a broader world, you may experience it as opportunity. That is why the biggest opportunities often appear when people recognize a structural change early. The point is not to jump from one extreme to another. The point is to gradually align your portfolio with the world as it is becoming. Not only the world as it used to be, the world is becoming more multipolar. That means more global exposure matters. The world is carrying more debt. That means hard assets and inflation hedges matter. The world is seeing more currency competition. That means dollar concentration matters. The world is still led in many innovations by the United States. That means US exposure still matters. A good portfolio can hold all of these truths at once. That is what many people struggle with. They want one story: America wins forever, America collapses tomorrow, China replaces the dollar is untouchable, gold is the only answer, stocks are the only answer, emerging markets are the future, emerging markets are a trap. Reality is usually more balanced than slogans. The United States can remain powerful and still deliver lower relative returns. The dollar can remain dominant and still weaken. China can rise and still fail to replace the dollar. India can grow and still be volatile. Gold can be useful and still not be a complete portfolio. Commodities can hedge inflation and still suffer drawdowns. US stocks can be expensive and still include world-class companies. That is why you need a portfolio, not a slogan. Now, if I were translating this into behavior, I would think in terms of layers. The first layer is the US core. This remains important because the United States still has many of the best companies and deepest markets. You do not discard that. The second layer is international developed markets. These provide exposure to countries outside the US with established markets, different currencies, and different valuation profiles. The third layer is emerging markets. This adds exposure to places where growth may be stronger, demographics may be better, and valuations may be more attractive, but risks are higher. The fourth layer is hard assets. Gold and precious metals can provide a hedge against currency and geopolitical risk. The fifth layer is commodities or real asset exposure. This can help in periods of inflation, supply shocks, and changing trade patterns. The sixth layer is flexibility. Cash or short-term liquidity gives you the ability to rebalance and act when opportunities arise. But it should not become a permanent substitute for productive assets if your time horizon is long. This is a framework, not a rigid formula. The right percentages depend on age, income, risk tolerance, goals, tax situation, and time horizon. But the logic is universal. Do not depend entirely on one country, one currency, one asset class, or one story. That is the essence of diversification. There is another important point. Diversification often feels unnecessary right before it becomes valuable. When US stocks are outperforming, international diversification feels like a drag. When the dollar is strong, currency diversification feels pointless. When inflation is quiet, commodities and gold feel irrelevant. When mega-cap technology is rising, everything else feels inferior. That is why most people add diversification too late. They wait until the diversifier has already gone up, then they chase it. A better investor accepts that diversification means owning some things that are not working right now so that the portfolio is more robust when conditions change. That is emotionally difficult, but it is rational. A fire extinguisher is not useless because your house is not currently on fire. A diversifier is not useless because the regime has not yet changed. It is there for the regime change. That is how I think about gold, commodities, and international exposure in this context. They are not predictions that America must fail. They are acknowledgments that the world is broader than one market. The mother argument makes an important point about the United States becoming not the only superpower, but one of several major powers. That is a very different world from the one many investors grew up in. In that world, returns may be more dispersed. Growth may come from more places. Currency movements may matter more. Geopolitical alignment may matter more. Commodity supply chains may matter more. Sanctions risk may matter more. Payment systems may fragment. Investors may need to think globally by default. That is not a threat if you prepare. It is a threat if you assume nothing changes. The biggest danger in markets is often not volatility, it is complacency. Complacency says, the thing that worked will always work. Principled investing says, the thing that worked may keep working. But I must understand why it worked and what could change. Why did US concentration work? Because the US had strong growth, innovation, reserve currency advantages, liquidity, global capital inflows, and leading companies. Which of those remain? Many remain, which are changing. The relative reserve currency advantage may be weakening, global growth may be spreading, valuations may be higher, other markets may be more attractive, debt burdens may matter more. That is enough to adjust even if it is not enough to abandon. Now, what about crypto? The source argument mentions that some people allocate a small portion to cryptocurrency as a way to diversify beyond traditional finance. I would treat this carefully. Crypto can be extremely volatile. It can have technological, regulatory, custody, and behavioral risks. It is not the same thing as owning gold or a broad international index fund. It may play a role for some people, but it should be sized with humility. If someone chooses to own it, the platform, custody, security, and risk controls matter, but I would not let crypto become the center of a retirement or long-term wealth plan unless the person truly understands the risks. Again, the principle is balance. You do not need to chase every alternative asset to recognize that the dollar system is changing. The simplest changes are often the most effective. More global equity exposure, some emerging market exposure, a small hard asset hedge, measured commodity exposure, continued ownership of high-quality US assets, periodic rebalancing. A long time horizon that can be enough. Now let us think about the next decade. If the US delivers lower returns than investors expect, the disappointment may not feel dramatic at first. It may simply feel like a market that moves sideways, a portfolio that grows more slowly, and a sense that the old playbook is not producing the same results. At the same time, international markets may quietly do better. Emerging markets may become a larger share of global capitalization. Foreign currency appreciation may add to returns for us investors. Gold and commodities may provide protection during inflationary or geopolitical stress. The investor who prepared may not need to make a dramatic move later. The investor who ignored the shift may be forced to react after prices have already moved. That is why positioning early matters, not because you know exactly what will happen, because you know enough to avoid overdependence. The world order is not a light switch, it is a tide. You do not notice each inch of movement, but over time the shoreline changes. The investor's job is to notice the tide before the house is underwater. That is why I think this moment matters. China reducing dollar exposure is not the whole story. It is a symptom. The dollar's declining reserve share is not the whole story. It is a symptom. Central bank gold buying is not the whole story. It is a symptom. BRICS payment systems are not the whole story. They are symptoms. Institutional forecasts for stronger international returns are not the whole story. They are symptoms. The story is that the global financial system is becoming less one-directional for decades. Capital flowed toward the United States because it was the obvious center. It may still flow there during crises, but over time more capital may remain in or move toward other regions. More trade may be settled outside the dollar. More reserves may be diversified. More growth may come from outside the US. That is not a collapse. It is a rebalancing. And rebalancing creates both risk and opportunity. If you are concentrated in the old balance, it is risk. If you position for the new balance, it can be opportunity. I want to make the ending practical. You do not need to become a currency trader. You do not need to bet against America. You do not need to predict China's exact reserve strategy. You do not need to know which payment system will win. You do not need to guess whether any institution's forecast will be exactly right. You need to ask whether your portfolio is robust. Does it own the US but not only the US? Does it own companies but not only one cluster of expensive mega-cap companies? Does it have international exposure? Does it have emerging market exposure sized appropriately? Does it have some hedge against currency and debt risk? Does it recognize that commodities and real assets may matter in a changing world order? Does it give you flexibility? Does it avoid panic? If the answer is yes, you are better positioned than most. If the answer is no, small changes now may matter a great deal later. That is the opportunity. The world is getting bigger, the investment map is getting wider, the old American-centered playbook may still be useful, but it may no longer be sufficient by itself. The investors who understand this do not need to panic, they simply need to adapt. Adapting early is usually less painful than adapting late. That is true in markets, in business, in geopolitics, and in life. A system that brought enormous wealth for one generation can become more fragile for the next. If people mistake the past for a permanent law, the United States may remain powerful, the dollar may remain the most important currency. US companies may continue to innovate, but the relative advantage can narrow. And when relative advantage narrows, diversified investors can benefit. This is not the end of the dollar. It is the beginning of a more complicated dollar world. This is not the end of us investing. It is the beginning of a world where US investing may need to sit alongside international growth, emerging markets, gold, commodities, and a wider understanding of global capital flows. That is why I would not ignore China dumping dollars. I would not exaggerate it either. I would see it as one more signal that the world is changing in a direction that rewards flexibility. The dollar system was built in one world. Your portfolio has to survive the next one. That is the principle. And if you understand it now, before the shift becomes obvious, the next decade may not be something you fear. It may be one of the most important opportunities you have to protect your wealth, broaden your exposure, and position yourself for the world that is coming rather than the world that already passed.